Welcome back, everybody, to today's episode of the Informed Homebuyer Podcast. I'm your host, Rich Curtis, and as always, I have with me my co-host, Dave Miller. Welcome, Dave.
Hey, Rich. Thanks for having me.
All right, so we are talking about the post-tariff interest rate effect. So what happened immediately after the tariffs, what's happened over the past couple of days since the tariffs, and then we're going to game out some scenarios of how we see this affecting the housing market moving forward. Now, I do always operate, by the belief that if there's an elephant in the room, name it. And these days, it's hard to talk about anything like this without talking about politics. And this show is not a political show. So what you're going to hear today are our economic takes. We all have our own beliefs on the politics, but we're going to work in the realm of facts and economics, and there's going to be some crystal ball work in there for you, but these are not political takes on what's going on. Regardless of how we feel about the tariffs, they are here. How is that going to affect us? That's our focus today. If you're looking for a political send up on this, you should try a different podcast for that. We're not going that route today, but we are going to cover how this is going to affect the housing market, our best estimates into that. And we're going to start right away with Dave telling us what happened to the stock market, and then how did that affect the interest rates right after Trump announced that day that at midnight tonight, we're going to go ahead and put in those 25% tariffs on Canada and Mexico, an additional 10% on China on top of the 10% he did previously. So a total of 20% on China. That's where we stand at the moment.
Yeah, Rich. And I think what I'm going to do here, probably the best thing to do, let me share my screen. I'm going to pull up the bond market, which is oops, let me go to screen here. I'm going to bring up an image here. And you would think I would have this down as many times as we've done this to just quickly navigate, but let me pull up in it, because I think once you share this, then we are in good shape.
This is what happens when you have a realtor and a lender trying to do tech displays and work technology.
Yeah.
We're great with contracts and paperwork. Computers aren't our thing.
Yeah. Okay. So upload file. Here we go. Let's go. There we go. Let's see if you can show that. And I just hit an upload. There we go.
Yep, you got it. There we go. And so this is the mortgage-backed securities market here that we're looking at, correct?
Yep. This is the
Let's assume our audience didn't watch our previous one. So explain to them what this is, why it's important.
Okay. So we were looking at the 3-month mortgage-backed security, and this is what's called a candlestick chart. And so from mortgage perspective is anytime you see a red candlestick, that means that mortgage interest rates are worsening, and green chart shows that mortgage interest rates are improving based on the 30-year mortgage-backed security. So I think you could see the date down below. I don't think anyone could see my cursor on this screen, but if you go to the February 3rd down at the bottom and you go straight up, you can see that's when the tariffs first were made effective, and then we had a 30-day pause on those tariffs. So you could see we saw a short-term decline in mortgage-backed securities, which made interest rates worse. Okay, then you start seeing
mortgage interest rates went up.
At that mortgage point, interest rates went up. Yep, the 30-year. So it's an inverse effect. So when red bar goes down, it's negative. So the green is good, red is bad for mortgage rates. Okay. So if you see that red bar that's just to the right of February 3rd, and then right in that window there is when we put a pause on those 25% tariffs. Then we start.
And then it got good again.
It got good again. And then we've constantly seen an improvement until here we are today, where you can see that current mortgage-backed security. I think we're right around, we closed it just under what we call 100 basis points, or 99. And so that equivalent from where we were on that the low bar February 3rd to where we are today is about 1/4 to 3/8 in mortgage interest rate.
Beneficial.
Lowering.
Yes.
Yep.
And where's the date? The tariffs were announced on the 3rd, correct?
February 3rd, and
March 3rd.
I'm sorry.
Or they put into effect. Sorry.
Yes. That's March 3rd. That's a couple days ago. So we've actually, now the reason why what we've seen happen is we've seen the flight from equities to bonds. So even though you would think with these tariffs being re-implemented that our bond market would go down, but that didn't happen. Bond market actually slightly improved, the mortgage-backed security, because there was a flight from equities to the bond market. So people are getting out of the stock market because of the fear and uncertainty. And if you look at the Dow over this last several days, we've been down quite a bit. One day, I think a couple days ago, we were down 900 points. And so what we're seeing here, and historically, I've been doing this for a long time. 20 years ago, I was still looking at these charts. Anytime the stock market was down, mortgage interest rates got better. And that was almost within a day or 2 days time. So now that's all changed quite a bit over the last several years, where now I can't predict what's going to happen. I've seen the stock market tank, and I've seen mortgage interest rates go down simultaneously. And I think Rich, you and I were talking when the first tariffs came out in early February, on February 3rd. We thought it was best to lock anyone in because we thought the crap was going to hit the fan, so to speak. And so,
which it did temporarily.
It did come for 3 or 4 days. And then, we improved, almost for, 8 to 10 days straight at that point in time.
But in that case, and it's working differently now, because in that case, it improved because he paused the tariffs. So he announced the tariffs, the stock market freaked out, things got worse. And then he paused the tariffs and everybody said, oh, we're okay. And then it got better. But what's happening now is a little different. He actually implemented the tariffs, which has caused people to be afraid in the stock market. So they're selling off their stocks because they think the stock market's going to plummet. And they were right. Although it's a bit of a self-fulfilling prophecy. When they start selling off, it starts dropping more. But they sold off, and then they need someplace to move their money. And what's safe and stable is the bond market. So what's created, and tell me if I got this right or wrong, Dave, what's created the beneficial mortgage rate environment where we've seen rates come down in the last 3 days since the tariffs went into effect is actually a lot of fear and uncertainty in the marketplace, causing a flight to bonds, and that dropped the interest rates. So the tariffs are not having a beneficial effect on interest rates. The fear they've created in the marketplace is making people run to a safe haven, which has created a beneficial bump in interest rates.
That is correct. You said that, I would say, eloquently. So, yeah, that is correct. And I also think simultaneously and this is, again, we're cautious to make predictions, but I also think, my opinion is, there's some, maybe some motivation here from the administration to cause some short-term pain by doing this, that is going to allow inflation numbers to continue to decrease, to get closer to that 2% target rate that the feds are looking for, to allow the feds to then turn around and start lowering interest rates. So we've already heard, and there's different pundits that projecting, I've heard anywhere from 1 to 4 potential rate cuts still this year. And from the feds. And that's
just to clarify for everybody, that does not mean mortgage interest rate cuts. It does most often have a beneficial effect on mortgage interest rates, but it's more about what they say and how they say it, and whether their predictions line up with what they do, whether it affects our industry and your wallet in terms of interest rates beneficially or not. So I just don't want to give the sense that the Fed is cutting mortgage interest rates 3 times this year. That's not how it works. We have a great podcast on that for you that you can go and watch, where we deep dive into that. But in general, it likely would have a beneficial effect on mortgage interest rates.
That is correct.
If that happens.
That is correct. We will typically see that that correlation, not a 1-to-1, but that correlation with mortgage rates improving as the feds lower the Fed fund rate. So
and now the problem with all of this is that in terms of a prediction, one, it's really hard to make any kind of financial predictions more than a month out, especially an environment like this, where fiscal policy's flying off the Resolute desk quicker than you can say Sharpie at this point, and we kind of can't keep up, right? So to some degree, we're going to have to just keep coming back on here and tell you what it did, how it is affecting things, and that's much more valuable than what we think will happen. However, in the event that this is an intent, and we don't know that it is, but in the event that this is an intent to inflict some short-term pain to bring inflation numbers down, to get interest rates down, because that was a campaign promise, that will not create a long-term beneficial effect for the real estate market. Most likely, if that were to happen, things would then swing back the other way. and the interest rates would start to rise again. Or if the tariffs stay in effect too long, it would break the economy to the point where, sure, you can get a 5.5% interest rate on your house, but you don't have a job or enough money to pay for it, or everything else in your life costs so much that you now can't afford as much mortgage payment as you thought you did because you're paying for those tariffs. So the good news, there's not a lot of shining light out there to bring to you guys in financial news, but the piece of it here is, for the time being, for the short term, if you're shopping for a house right now, this actually did help you. So if you're shopping for a house right now, take advantage of it. Look at the rates. May want to look at locking in now while we have this blip of lower rates, because my take long term on rates for the year, and then Dave, you could tell me what your take is I still think we're flat to worse by the end of the year overall on rates.
Yeah, and yeah, I actually see it a little bit the other way, Rich. I see us flat to improving a little bit, but
Yeah, interesting.
simultaneously, and again, referring to another podcast, is the cost for that home's going to increase. So even if rates stay flat, if we don't see a reduction in the cost of, resale or even new construction, what you pay today versus what you're going to pay 6 months or a year from now, it's still going to be cheaper if you can swing it to do it now than later.
All right.
Even if
So now,
even if rates were to come down a bit. Yep.
all right, so we're on record here, folks. I have said
Mm,
flat to worse by the end of the year. Dave has said
mm,
flat to better by the end of the year. So I guess
yeah.
flat, we split our New Year's Eve round of drinks.
Okay.
Better, it's on you. Worse,
Yes.
it's on me. So
And you have to admit on the podcast that you were wrong.
that's
Yes.
that's
Yeah.
right.
Okay.
Are
Yeah.
you allowed to drink? Are you allowed to drink a beer live on
I
YouTube? Maybe we'll do the podcast from a bar, and
yes.
we'll pay up, and we'll
Okay.
admit who got it
Okay.
right or wrong.
Perfect. Yeah. I think we could hold it up. I think commercials, I don't know if you could actually drink the beer, but you could hold it
We
up.
have to
So
put water in a
yes.
coffee mug and pretend.
Yes.
So
There you go.
this, see, this is how civil political discourse is supposed to
Mm.
be, folks. We just you bet a beer on it, and you smile and walk away. But let's talk about, Dave made an important point there. We were being a little tongue in cheek, but Dave made an important point there that even if his prediction is right, and hey, I'm on board, I'm in. I hope it is. I hope rates are better by the end of the year. It's likely that housing prices will be worse, and housing prices hurt you a lot more than small fluctuations in rate. Big fluctuations in rate. When we went from 3.5 to 8, that affects you worse than housing price increase. But when we're talking about going from 7 to 6.5, even 7 to 6, the increase in home prices could hurt you worse. And so the effect of the tariffs on home prices could be substantial. So we get like 70% of our gypsum and dimensional lumber from Canada and Mexico, respectively. So gypsum being the core ingredient in making
Sheetrock.
drywall.
Yeah.
Sheetrock,
Sheetrock.
yeah.
There you go.
So that's going to raise the cost of homes across the board. We get 30% of our soft goods and fine lumber, your finishing lumber, your cabinet grade lumber, from Canada. We get 16.9% of our plywood from Canada, and we get 100% of our wood shingles from Canada. And that 100% is an interesting number to look at, because we are being told a lot of untruths about what tariffs are. So let's start with, no foreign country has ever paid a tariff when importing goods to America, nor will they ever. The American company pays the tariff. So if there's an American company who is importing cedar shingles for your Craftsman house in Berkeley that you're building, they are paying the tariffs. And we get 100% of those shingles from overseas, which means we don't have a domestic industry to pivot to buy them from, which means those are going up 25%. And so is the cost of putting that siding on your house. So these
So we
are
just can't
taxes.
pop that up overnight, Rich, and have an industry that could build those?
Yeah. It turns out they don't, and we were talking about this before the podcast, that the Biden administration actually eased restrictions on logging to try to increase domestic lumber production, to try to increase the homes we're building, to try to have a positive effect on the housing shortage. Trump has just signed into law further decreases on that. Being a wilderness advocate myself, I'm not a big fan of either Biden or Trump's decision there. However, the effect on the industry was nothing, because people were falling all over themselves to build lumber mills, and it takes 3 to 5 years to bring a new lumber mill online. So now we can extract the resources easier and legally, but we can't process them to get them to the job site in time. And now we either can't buy them from Canada, or we have to pay 25% more for them from Canada. So what does this mean on the ground? Because on both sides, one side will tell you it's going to do nothing of the political spectrum, and the other side will tell you the world's going to end. And the truth, as usual, is always in the middle. So according to the National Association of Home Builders, the cost of your average new construction home based on the tariffs alone will go up about $5,000. Now, that's not the whole pie. That doesn't include the effect of retaliatory tariffs or the effect of, say, Canadian companies just refusing to sell to American companies and we can't, that's too much crystal ball work. Dave and I aren't smart enough to tell you how that's going to affect things. But right off the bat, National Association of Home Builders says this is going to make new construction go up at least 5%, while at the same time making house size go down. So not only are you going to pay $5,000 more for the house you're purchasing, it's going to be a smaller house. You're getting less for your money, because the only way to control the cost of building a home when the cost of the supplies go up is to use less supplies, meaning make a smaller house. And there's only so many ways to control that. An 800 square foot house and an 8,000 square foot house has to have a kitchen, has to have a bathroom. So the only place you really can cut those costs effectively is in accessory square footage, the size of bedrooms that don't have infrastructure like kitchens and bathrooms. So what does that mean for the residential resale market? Well, we have massively low inventories. Dave and I were going over that. We're still at, essentially COVID level inventories, 2.1 months of inventory in Placer. That means that the rate homes are selling right now. If no more homes came on the market today, I'd be out of homes selling 2 months. Downtown, Midtown, East Sac, 1.87, less than 2 months of inventory, making it still a strong seller's market. The only thing that eases that inventory is either rates coming down and people, saying, oh, I'm willing to sell my house now because it won't cost me so much to buy another one, and the building industry. So if there is a flight away from new construction because it just got too expensive, or people can get more home in the residential resale market than they can for their money in new construction because the house sizes have come down, then that would create a bigger buyer pool for our low inventories and cause resale home rates to rise as well. That is the current speculation or projection coming out of the National Association of Home Builders. So we're looking at an increase in new construction and in resale construction due to the tariffs if they stay at current rates. And Dave, when it comes to your end of things, when someone gets pushed up on price, we start to see people fall away in terms of affordability or number of buyers that we're working with typically. Is that right?
Yep, that is very fair to say. And we always, I think we've done another podcast too in terms of purchasing power, in terms of an eighth to a quarter in interest rate, and you nailed it. Like a home going up by $5,000 typically does not affect affordability. Interest rate going up by an eighth, maybe even a quarter, doesn't really affect affordability. Now, when we're talking a half a point plus, especially on a $500,000 purchase price, or a $10,000 to $20,000 increase in price, now affordability is affected. So incrementally, when you and I are very conservative, when we're, working with folks, that if someone's looking for a $600,000 house, they typically don't all of a sudden only qualify for a $500,000 house, or they will magically qualify for a $700,000 house. We usually, understand their needs and wants, and we are showing them in a range what their affordability is over a single day, over, a period of time, and always let people know, hey, prices could go up, 1%, 2%, interest rates could go up an eighth or a quarter. If that's going to affect your buying decision, maybe we're in the wrong time to be looking for a home.
Yeah. It is beneficial if they go down. Yay, it's cheaper. Great. But if that's going to be a go or no go decision maker for you, then maybe your budget's a little too tight for home ownership now, particularly given the overall financial,
Right.
craziness going on. I think, in terms of, like I said, the silver lining here is that right now, if you are a buyer shopping right now, anywhere in the country, we're in California, but this is going to be the same for all across country. If you're in process right now and you have not locked a rate in yet, you did just get a little bit of a discount. How much are we down, say, from the day he put the tariffs in to now, average rates dropping down?
Okay. Are you talking just the recent tariffs?
Just the recent tariffs, mortgage interest rates from,
Yeah,
the
I would say we're
third
a
to now.
quarter point better in interest rate.
Quarter
Yep.
point better. So that's not nothing, right? So
No. Yeah.
the good news is, hey, we've gone down a little bit right now. Now, how do you wrap your mind around all of this, and what does this mean? and this gets into real crystal ball work. And Dave and I might have some disagreements here. The big three automakers came in and explained to Trump that this whole thing was going to cost make American cars go up by 20%. And he did pause the tariffs on automobiles like almost instantaneously. It was about 24 hours in, right? So that shows that there are people that can have an effect here, and that the financial realities can have an effect here. And we can see an easing of this. So to Dave's point, if we are inflicting short-term pain to bring the inflation rate down, there's a chance he backs off on these tariffs, and any backing off on these tariffs is going to have a beneficial effect to the economy. Now, that means mortgage interest rates are probably going to do more of what I said, be flat to worse, but it means that home prices won't run away and go up on you. So at least we're working in a stable environment. So a little bit of good news there is we could see some easing of the tariffs over time. But we are going to continue to see the effects of this trade war sort of trickle out. There is now a sour taste in the mouths of some of our trading partners that are making some of them, move to more domestic sources for goods and services that may not come back our way even after an easing of the tariffs, or might take some time. So I think we are going to continue to see the effects of this trickle out over the next year in the housing market, and we will continue to bring updates to you as that happens, how it's affecting you. But for now, I think if you're out shopping right now, it's good. If you're going to be shopping 6 months to a year from now, subscribe to the podcast and we'll let you know then what's going on.
Yeah. And I think, in terms of, I'm always cautious. The 30-year mortgage-backed securities really is what's going to indicate the mortgage rates. But as a consumer with, you won't have readily access like I do. I subscribe to a service and I'm watching that mortgage-backed security, all day, every day. The 10-year treasury is another good indicator of how rates are moving. So, an example here is currently the 10-year treasury is just about 4.3. It's 4.29. But if I go back to February 2nd, we were at 4.53. So that just shows you there's a quarter point right there, roughly. Mortgage interest rates on average there's going to be the mortgage, what they call a mortgage spread between the 10-year treasury is usually going to be at this point in time right now, somewhere in the 2.5 range. So if I have to be cautious quoting mortgage interest rates. So if if you're looking at 4.3 on the 10-year treasury, if you add roughly 2.5, you're looking at 6.8-ish range on a mortgage rate. So again,
so
that's
a way you can track it at home yourself. Go online, look up what the yield is on the 10-year treasury note, and kind of get a sense of that. 2.5 number fluctuates. Historically, it's closer, correct me if I'm wrong, Dave, to 2. So the 2.5 is more of an inflationary effect. Is that right?
Yes. And the spread, that mortgage, what they call it, the mortgage spread can go as low as 1. So it's anywhere between 1 for 2.5. So I'm just using kind of where we're at on the current spread on average. And again, I'm always going to quote a little bit higher on the spread, or try to, so that, if a consumer's looking at rates, I'm just always a big fan of, they most likely will be better than you think, and they are than worse. Just to give, just from that conservative approach.
Yeah, I agree. And I think overall, from the 30,000 foot view, anything that right now that decreases mortgage interest rates is probably an effect of a negative impact on the economy as a whole. And so you may personally be feeling some other effects from that, whether it's underemployment or unemployment or things like that, as these, the effects of the tariffs play out in the economy. So, in general, as you're watching these interest rates, come down, just know that is also probably having some negative effects in the economy that we're going to potentially have to pay the piper for down the road. So to all of you out there, we don't give financial advice, but our 2 cents is to be playing it conservative with your home purchase price, be playing it conservative with having some reserves on hand. And if you're that well-qualified, well-funded, stable employment buyer, then hey, get out there and take advantage of a quarter point better rate right now. And if you're not, if you were that on the ragged edge of affordability buyer, or you're in some of the industries that are being impacted right now that might see further, cuts or layoffs, you might want to keep your powder dry for a bit and keep the money close to the vest and wait and see how your employment does. I don't think we are going to see enough dramatic swings on interest rate between now and the end of the year for it to be a decision-making factor in your home purchase. Would you agree with that one, Dave, or are we betting some more
Yeah.
beers on that one?
No, I would say I agree with that. And I say the other component to this that brings up back to a previous podcast is saying to pause or to buy. There's also the opportunity to not buy your forever home, but get in the market and buy an investment home that is something that's a little bit more conservative, maybe a smaller home, a home that you can convert to a rental that's more affordable now, and then buy up later and just kind of wait and see. Because when you're in the market and the market increases, and I think you used that analogy before, an 800,000 home that increases 10% is 80 grand. A $500,000 house that increases 10% is 50,000. But so there's a $30,000 loss there. But if you weren't in the market, you made none of that gain. So
yeah. I think that was last week's podcast. I think it's called something like Trump. What is it called? It says Trump economy alert: why starter homes beat forever homes in 2025. So if you are out there shopping for the big house that costs big money, and all of this is making you a little bit nervous, but you still want all the benefits of being in the real estate market and all the benefits of home ownership, go back and watch last week's video on that strategy. I think it's a really good one to consider right now. I think that's probably a good place to wrap this one up. This was meant to just be a short update for you on how the tariffs have affected things right now. Short answer is a little bit positively for mortgage interest rates. So, hey, we'll take the win. Long answer is it's a lot more muddy than that. So watch this space, subscribe, and we will keep you updated as things go along.
Hey, and I look forward to having a beer on your dime too. So can I? Well, maybe I have to buy it myself. I don't know how these regulations work. So maybe I'll buy my own beer, but I'll say on behalf of Rich. So
we'll have to see. Maybe the Trump White House will deregulate drinking on camera by the end of the year.
Yeah.
All right, guys. Thank you so much. As usual, we really appreciate you watching, making it to the end with us, and we will see you guys on the next one.
All right. Thanks.
All right. Thanks, Dave.